How banks treat you at every level of wealth. Banks present themselves as a service. Same logo on the door, same app on your phone, same name on the statement. But the experience inside that institution is not the same for everyone. It changes, significantly, systematically, based on one variable: how much money you have with them. This isn't a conspiracy. It's not even hidden. It's just how the business works. And understanding it clearly tells you something important, not just about banks, but about how to navigate them at whatever level you're currently at. Let's walk through it honestly. When your balance is low, and I mean genuinely low, under a few $100s, maybe dipping negative some months, the bank's relationship with you is almost entirely automated. You are a small account. The system that manages small accounts is not designed for your benefit. It's designed to either extract small revenues from you or wait until you become more valuable. The overdraft fee is the clearest example of this logic in practice. You go negative by $12. The bank charges you $35 for the privilege of covering it. The fee is larger than the deficit. This is legal, common, and applied without anyone reviewing your account or your circumstances. A rule fires. A fee lands. Some banks have reduced or eliminated overdraft fees under public and regulatory pressure. But the ones that still charge them collect billions annually, and the majority of that comes from a small group of accounts that are chronically just below zero. The same people, paying repeatedly, for a service they wouldn't need if they weren't broke. There's no customer service relationship at this level in any meaningful sense. If you call, you wait. If you dispute something, you're routed through a script. If you ask for an exception, you might get it, or you might not, depending entirely on which representative answers and what their authority allows that day. The experience is inconsistent because you are not a priority. You are a cost center. Monthly maintenance fees may apply because your average balance doesn't meet the minimum threshold, which, at most major banks, is somewhere between $500 and $1,500. The fee exists to compensate the bank for servicing an account that isn't generating much revenue. The bitter irony is that the people paying it are the ones who can least afford to. If you had $1,500 sitting untouched, the fee would vanish. But you don't, so it stays. Something shifts when your income stabilizes and your balance starts holding a consistent floor. The bank notices this algorithmically. A steady direct deposit, a balance that doesn't hit zero every 2 weeks, a pattern of regular activity, these signals move you into a different behavioral category in their system. Not a better relationship. A different profile. The fee waivers kick in. Your direct deposit usually qualifies you for a fee-free checking account, which sounds like a perk but is really just the bank removing a penalty that was always a bit arbitrary. The account stops costing you money to maintain, and you start keeping what you earn. Credit card offers appear. Real ones, not secured cards. The limits are modest, $2,000, maybe $3,500, and the interest rates are still high because your credit history is short and the bank is still pricing risk. But the door is open in a way it wasn't before. When you apply for a small loan now, it gets processed. Not instantly, not cheaply, the rate might be 11 or 12%, but it works. The system approves you, money arrives, the problem gets solved. That might sound unremarkable. It isn't, if you remember what it felt like before. What's actually happening here is simple: you've become a viable revenue source. Your card usage generates interchange fees. Your loan generates interest income. Your growing balance gets lent out at a spread. The bank has a reason to keep you now, which means it has a reason to provide basic, functional service. You're a customer. Not a valued one. Just a standard one. That's still progress. As savings accumulate, let's say you've got $20,000 to $30,000 across checking, savings, and a small investment account, the bank's behavior toward you starts to change in ways that are subtle but real. Credit limit increases start happening without you asking. You log in one day and your limit has gone from $4,000 to $10,000. The bank is extending more credit not because you need it, but because your history proves you won't abuse it. You pay on time. You don't carry a balance. You're low risk. Loan pricing gets better. The car loan you take out at this stage costs 7% instead of 11%. That's a meaningful difference over 5 years. Not because the bank likes you more as a person, they don't know you as a person, but because your financial profile has shifted the risk calculation, and lower risk gets a lower price. This is one of the quieter ways wealth compounds through the banking system even before the wealth is large. Better rates mean you pay less for the same things. Paying less means more money stays on your side of the ledger. More money builds faster. The system begins, slowly, to tilt in your favor. Once assets cross into the six-figure range, $100,000 in savings and investments, a growing retirement account, a credit history that's genuinely strong, the experience you receive starts to feel qualitatively different. Hold times shorten. Not because you requested it, but because accounts at your asset level are flagged for priority routing. The person who picks up is more senior. They have more tools available. When something goes wrong, a fraud hold, a wire that didn't land, a fee that appeared without explanation, it gets fixed in the same conversation. Not escalated, not ticketed, not resolved in 3 to 5 business days. Fixed now. A dedicated banker may appear. At some institutions this is formalized, at others it's more informal. Either way, a named person emerges. Someone who knows your account, who reaches out occasionally, who can be emailed directly. The relationship is commercial, their performance metrics depend partly on retaining accounts like yours, but the utility is real regardless of the motivation. Having one person who knows your situation is genuinely more useful than being routed to whoever answers. Premium products open up. Better credit cards, investment accounts, mortgage pre-qualification. The institution is now thinking about your future business, not just your current balance. That's a meaningful shift in how they position themselves toward you. At $500,000 and above in investable assets, the bank stops being a place you occasionally deal with and becomes something closer to a professional service you actively use. Wealth management gets offered. This bundles investment advice, tax coordination, estate planning, and financial planning under one relationship. The quality varies enormously by institution and by the specific person assigned. Some advisors are excellent, some are sophisticated product salespeople. Learning to tell the difference quickly matters, because the difference costs money over time. The conversations are substantive. Someone is asking about your goals, your timeline, your family situation. Not because they care about you in a personal sense, but because a full picture lets them offer a broader range of products. The motivation is commercial. The experience is genuinely useful. Both things can be true at once. What you're really gaining at this level is resolution speed and access to discretion. When something complicated happens, an unusual transaction, a large transfer, a loan structure that doesn't fit a standard product, there's a human being with authority who can handle it. Not a script reader. Not someone who needs to ask a manager. Someone who can make a decision and does. Above $5 million, the logic of the institution reorganizes around you rather than the other way around. Products that don't appear on the website become available. Rates that aren't posted anywhere get offered. Investment minimums that technically exist get waived because the relationship justifies it. The mortgage rate offered to someone at this level is not slightly better than what's publicly advertised, it's meaningfully better, negotiated rather than selected from a menu. Your advisor, if the institution is serious, isn't a generalist. It's a small team. One person handling investments, another handling tax strategy, another handling estate and trust structures. They coordinate with each other. They meet with you on your schedule. The room where those meetings happen doesn't look like the lobby where everyone else waits. What's being offered here is something close to institutional infrastructure for your personal finances, the kind of coordinated, proactive attention that large organizations typically employ entire finance departments to provide. The rules don't bend. But the discretion built into those rules gets exercised consistently in your favor. Fees that technically apply aren't charged. Approvals that require manager sign-off get handled before you've finished asking. The automated indifference of the early levels has been replaced by human attentiveness, because losing your account would be noticed, would matter to someone whose career involves not letting that happen. Here's what all of this actually tells you. Banks are not a neutral service provider that treats everyone equitably. They are a business that allocates relationship quality based on revenue potential. The more valuable you are to them, the more they invest in keeping you. That's rational from their perspective. It's worth understanding from yours. If you're in the early levels, the practical implication is straightforward: minimize what you pay the bank, avoid overdraft fees, find fee-free accounts, use credit cards without carrying a balance, while redirecting as much as possible into assets. The goal is to move through the levels not by impressing a bank, but by building a financial position that the bank's own systems will eventually respond to. The experience improves as the position improves. That's not something a bank will ever say directly. But it's exactly how it works. And knowing that, you can stop expecting the bank to be on your side at the early levels. It isn't. It's waiting to see what you become. Your job is to become it on your own terms, using the bank as a tool rather than treating it as a partner.